Right now, if your Social Security and any pension arrive like clockwork every single month, and your checking account balance has been quietly climbing because you spend less than what comes in, you have a problem your bank will never point out to you. That balance sitting on your screen looks like safety. In reality, it is being pulled in two directions at once. It earns close to nothing, while your bank lends that same money out and earns a real return on it. And every month it sits there, it buys a little less than it did the month before, because prices keep climbing while your balance does not grow to match them. Neither of those losses ever shows up on your statement. Today, I am walking you through exactly what that idle money is actually costing you. The federal reporting rule around large transactions that quietly worries far more retirees than it should. How to make sure every dollar you have is actually insured, and the one system that fixes all of it at once. My name is Robert Hensley, and every week I go through the actual federal rules and the actual banking regulations that affect what happens to your money. Because your bank has no obligation to explain any of this to you voluntarily. I am not here to sell you anything, and if you are new here, hit subscribe and tap the bell now, since new videos post every Wednesday and Sunday. Before we get into the 5 things you need to know, I want to stop 2 different groups of people from tuning out right now, because both of you are about to make an expensive mistake if you do. The first group lives mostly on Social Security and a modest pension, watches every dollar, and assumes a video like this is for people with real money to manage. You are wrong, and you are actually the person most exposed to one specific risk we are about to cover, because an unexpected inheritance, an insurance settlement, or a home sale can push a single deposit past a federal reporting threshold you have never heard of. And not understanding that threshold is what turns routine paperwork into genuine fear. The second group is financially comfortable, has real savings built up over a lifetime, and assumes this kind of basic account management does not apply to them. You are also wrong, and for the opposite reason, because the insurance gap we are about to cover specifically threatens balances larger than most people realize, not modest ones. Stay with me through all 5, because the second one is the highest value item on this entire list, and I am not going to make you wait until the end to find out why. Number 1, the $10,000 reporting rule nobody explains correctly. There is no law against keeping a large balance in your account, and having money is never a crime. What actually gets reported is a specific kind of transaction. Anytime you deposit or withdraw more than $10,000 in cash in a single transaction, federal law requires your bank to file a routine form with the Financial Crimes Enforcement Network. This is automatic, mandatory, and happens thousands of times every single day across the country. If you deposited $14,000 from selling a vehicle and the bank filed that report, you have done absolutely nothing wrong, and in the overwhelming majority of cases, nothing further ever happens. Retirees encounter this more often than working adults, since selling a vehicle, receiving an insurance settlement, depositing an inheritance check, or closing out a certificate of deposit are all far more common in retirement than during your working years. Here is the part that actually matters, because the danger is never the report itself. It is the instinct people have once they hear about it. Deliberately breaking a large transaction into smaller pieces specifically to stay under that $10,000 line is called structuring, and it is a completely separate federal offense, carrying a penalty of years in prison, regardless of whether the underlying money was earned honestly and every tax on it was already paid. Prosecutors do not have to prove the money came from anything improper. They only have to prove the structuring itself was intentional. The rule that eliminates this risk entirely is simple. If you ever need to move a large amount of cash, Do it once, normally, and let the routine paperwork get filed. The report is harmless. Trying to avoid it is what turns a completely legal transaction into a federal problem. Number 2, and this is the one I promised you, making sure every dollar you have is actually insured. The Federal Deposit Insurance Corporation covers deposits at member banks up to $250,000 per depositor, per bank, per ownership category, a limit that has not moved since 2008. Every dollar above that limit, sitting in a single account at a single bank, is not guaranteed if that bank ever fails. And banks do fail. When they do, the split between depositors is not close. People under the limit get their money back quickly with barely any disruption, and people who let a balance drift above it, often through exactly the kind of quiet surplus we are talking about today, spend weeks in genuine uncertainty over money they assumed was already protected. Here is how to actually extend that coverage, and each phrase in that rule is a real tool. Per bank means splitting savings across 2 separate institutions creates 2 separate $250,000 umbrellas. So a retiree with $400,000 sitting at one bank has $150,000 sitting completely uninsured, while the same amount split across 2 banks is fully covered. Per ownership category means a single account, a joint account with a spouse, and a retirement account at the same bank are each insured separately. So a joint account alone can cover up to $500,000 at one institution. And adding a named beneficiary to a deposit account extends your coverage further still. Before making any changes, use the FDIC's own free calculator at fdic.gov/EDI to check your exact coverage across your specific accounts, since the precise math depends on your situation. If any of that surprised you, hit like right now, because Social Security and a pension arrive on a fixed schedule in a fixed amount. The buffer you need against income gaps is smaller than it would be for someone with variable income. One more detail worth building in. If your bills are due early in the month and your Social Security deposit lands in the middle, you need enough sitting in checking to cover those early bills before the deposit arrives. So build that lag into your number instead of discovering it the day a payment fails. Number 4, where everything above that checking line actually belongs, because the answer is not one account. It is a system built specifically for fixed income rather than the accumulation-focused advice most retirement content repeats. Your emergency reserve, 3 to 6 months of expenses, belongs in a high-yield savings account at an online bank, insured, accessible within a day or two, and earning meaningfully more than a standard checking account. Any money you know you will need in the next 6 to 24 months, a property tax bill, a planned repair, belongs in short-term Treasury bills purchased directly and commission-free at treasurydirect.gov, which carry the added advantage of being exempt from state and local income tax. A real benefit if you live in a state with its own income tax. And money you will not touch for 2 years or more. Your retirement accounts and long-term investments can carry more growth exposure, specifically because your fixed income already covers survival. So a market decline never forces you to sell it. There is one more piece almost nobody includes, and it matters most for exactly this kind of fixed budget: a sinking fund for the large expenses that arrive once or twice a year rather than monthly. Property taxes, an annual insurance premium, vehicle registration, a Medicare supplement premium paid yearly instead of monthly. Add up everything you pay this way across a full year, divide it by 12, and move that amount automatically into its own dedicated account every single month the day your income arrives. When the bill actually comes due, the money is already sitting there waiting. It never has to come out of your emergency reserve or your long-term investments, which is exactly what those two are supposed to be protected for. There is one more piece almost nobody includes, and it matters most for exactly this kind of fixed budget. A sinking fund for the large expenses that arrive once or twice a year rather than monthly. Property taxes, an annual insurance premium, vehicle registration, a Medicare supplement premium paid yearly instead of monthly. Add up everything you pay this way across a full year, divide it by 12, and move that amount automatically into its own dedicated account every single month the day your income arrives. When the bill actually comes due, the money is already sitting there waiting, and it never has to come out of your emergency reserve or your long-term investments, which is exactly what those two are supposed to be protected for. There is one more piece almost nobody includes, and it matters most for exactly this kind of fixed budget. A sinking fund for the large expenses that arrive once or twice a year rather than monthly. Property taxes, an annual insurance premium, vehicle registration, a Medicare supplement premium paid yearly instead of monthly. Add up everything you pay this way across a full year, divide it by 12, and move that amount automatically into its own dedicated account every single month the day your income arrives. When the bill actually comes due, the money is already sitting there waiting, and it never has to come out of your emergency reserve or your long-term investments, which is exactly what those two are supposed to be protected for. Number 5, the hidden interaction almost nobody warns you about when they tell you to move idle cash into something that earns interest. That interest is taxable as ordinary income the year you receive it. And once it crosses $10 from any single account in a year, your bank sends you a tax form and reports it to the government. That interest feeds directly into a formula called provisional income, which determines how much of your Social Security benefit is federally taxable, using thresholds of $25,000 for a single filer and $32,000 for a married couple filing jointly, figures that have never been adjusted for inflation since they were written into law. For someone already near that threshold, new interest income does not just get taxed on its own. It can also push a meaningful slice of Social Security benefits that were previously untaxed into taxable territory at the same time, a real cost that is larger than the interest itself. None of this is a reason to leave money earning nothing in checking. Earning nothing produces no tax, but it also produces nothing at all. And earning a real return while paying tax on it will always leave you further ahead than earning zero and paying no tax on it. The fix is simply to plan for it instead of being surprised by it. Update your W-4V withholding form for Social Security or your W-4P for pension withholding to account for the new interest income you expect to earn. So the tax arrives as a small routine adjustment to your withholding instead of a bill you did not expect the following April. If you are the retiree with real savings built up, here is the bonus round worth your attention specifically. If your total balance at one bank meaningfully exceeds the insured limit, splitting it across 2 or more institutions is worth the minor inconvenience of an extra login. And naming beneficiaries on your accounts is worth doing even if you already have a will, since it extends your FDIC coverage at no cost at all. And if you live in a state with its own income tax, specifically California, New York, or New Jersey, among others, Treasury bills deserve a second look, even for money you might otherwise default into a savings account, since the state tax exemption on that interest means your actual after-tax return can end up higher than a savings account paying the identical stated rate. Picture a woman named Louise, 76 years old, a widow living on Social Security and a modest pension from her years as a school administrator. Her checking balance had quietly grown for years, well past what she actually spent each month, sitting at one bank the entire time. When she actually sat down and worked through this, she found her checking account alone held far more than she needed, none of it earning anything, all of it sitting under one roof at one institution with no beneficiary listed on the account at all. She moved the surplus into a high-yield savings account and a set of treasury bills timed to her known annual expenses, added her son as a payable-on-death beneficiary at no cost, and adjusted her withholding to account for the new interest. Nothing about her life changed. She did not take on any new risk. The only thing that changed was how much of her own money was actually working for her instead of quietly sitting still. Here is exactly what to do this week. Calculate your real average monthly expenses using your last 3 months of actual spending, not a guess, and set your checking target at 1 to 2 months of that number plus a small buffer. Move everything above that line into a high-yield savings account for your emergency reserve and treasury bills for anything you know is coming in the next 2 years. Add a payable-on-death beneficiary to your accounts, one conversation at your bank, or one update in your online banking, at no cost. Calculate your sinking fund by adding up your annual expenses and dividing by 12. Then automate that transfer the day your income arrives. And update your withholding form to reflect the interest income you are about to start earning, so nothing about this surprises you next spring. Let us recap quickly. The $10,000 reporting rule is routine, harmless paperwork, and the only real danger is trying to avoid it. Your FDIC coverage can be extended well beyond $250,000 through multiple banks, ownership categories, and named beneficiaries. Verified directly at fdic.gov/EDIE. The right checking balance is 1 to 2 months of your real expenses, with everything else working across a system built specifically for fixed income. And any interest you earn is worth earning, even once you account for how it interacts with your Social Security taxes. Everything in this video is general education, not personal financial or tax advice for your specific situation. So confirm your own numbers with your bank, the FDIC's own tools, and a tax professional before making changes. If you know a retiree who has been leaving the same balance sitting and checking for years without ever running these numbers, share this video with them today. And if you have got a question about your own situation, drop it in the comments. Every Friday, I answer real viewer questions over on my post tab. If this helped you, hit that subscribe button and the bell so you catch every video the moment it goes live. 20 minutes with your own numbers is worth more than anything I could tell you in general terms. This channel provides educational information only and is not affiliated with the Social Security Administration, Medicare, CMS, the IRS, or any bank. This reaches the next retiree who needs to hear it. And if you have not already, subscribe, because I have more videos coming that go deeper into structuring accounts across multiple banks. Now, back to number 3. Number 3, the actual number that belongs in your checking account. Since knowing the first 2 rules only helps once you know how much to move. The right amount is 1 to 2 months of your real, verified monthly expenses, plus a small buffer of a few $100s to prevent an overdraft. Not your rough guess, and not a round number that simply feels comfortable. Your actual average pulled from your last 3 months of real spending, which is very often different from what people assume before they sit down and calculate it.